So the teaching topic tonight is brought to you by Trade the Fun. And I don't know if this is our official tagline, but we make traders better. And we do that by using our see one, do one, teach one method. So the shortest introduction possible about myself. My name is Pete Edmondson, otherwise known as Referee Pete in our Discord. I'm from Annandale, Minnesota. And just like many of you, I trade every day and I love it. And like some of you, I'm not a full-time trader yet, but that's the target. So I view trading Forex currencies as an amazing puzzle that can't be totally solved correctly every time. But it can be tamed from time to time. And that's what that's where all the goal is. That's what we're trying to do. All right. Now, to start off, you may be asking yourself, what is this see one, do one, teach one method? Every morning during our live trading session, we see how to trade from others. We do it ourselves in our live funded accounts. We may have demo accounts that we practice in. And then once we identify a part of the trading method that is a strength of ours, or that is a weakness of ours, we then take that topic, we study it, and we teach it. And so that's as simple as that. We see one, we do one, and we teach one. So that's what I'm doing here tonight. I'm taking a topic that I'm still learning on, a topic that I've recognized is a weak spot in my trading, and here I am teaching on it. And in the process of preparing to teach, it's pushed me to become a better trader, as I've had to study the topic in depth to act like I know what I'm talking about. So, recognizing market structure. In this video, we're going to talk about 3 questions. Why understanding market structure is vital for successful trading. How do we analyze and then use market structure with our trading method each day? And then lastly, how do we improve at recognizing market structure? All right. So now, as we start talking about these 3 questions, let's take a quick look at exactly what our trading method is here at Trade the Fund. In every hot seat live trading session, we are focused on mainly 3 types of trades, trading styles. Number 1 is called the 3 and 50 method. That's what we do every day in the New York session. And for overnight trade setups, we have not anything official for that name, so we just call it the overnight trade setup. And on some non-scalping times of the day, we also set up fractal trades. So those are our 3 trading strategies, trading methods. Those are the types of trades you will see us setting up in our trading sessions. Now, our entire 3 and 50 trading strategy works with a high success rate because it relies on this one staple that happens in the Forex market. It relies on volume. It relies on liquidity. So without that, the market can't be cyclical. It can't go up and it can't go down. And if it didn't, then we wouldn't have anything to trade, right? So there's a term that we use. It's in the industry, but we have our own little twist on it, and it's called price cycles. So you may have heard this before. Price cycle is simply put that a cycle of pips will go up 8 to 10. It may go down 8 to 10 pips. And in that range, we call that a price cycle. So because the market is cyclical, we plan our entire trading strategy around 1 price cycle up, 1 price cycle down, 2 price cycles up, 1 price cycle down, and so on. And quite often we'll see in our trading sessions 3 price cycles. But like most other traders, without volume, without liquidity, we're just going to close our charts and come back tomorrow. And on the very rare occasion, we will sometimes have 7 price cycles away from us. All right, now, as a part of our 3 and 50 method, and even in the overnight trade setups, although those are going to be other topics for different videos, the last thing that I want to point out is this. When we utilize our trade to fund methods, we can be early into a trade, we can be late getting into a trade, but we can still close out in profits. We can be wrong where we get into it, we can still close out in profits. We can set up our market analysis, and that original market analysis cannot work out in our favor, and we can still come out in profit. As a matter of fact, many of you, if you've ever seen our hot seat trading sessions, you'll notice how we make multiple errors in execution throughout our trading session. And because of our 3 and 50 method, we still have the opportunity to come out in profit. So we're going to proceed with the ultimate question of market structure. All right, let's dive into it. The moment that I know you've been waiting for, the definition of market structure, and it is the current structure of the market. I know it sounds silly that what is market structure? Well, it's the current structure of the market, but as simply put, the current structure is what the market is currently doing. And as we analyze that structure, that will give us a probability of where we think the market's going to go next. See, we've learned that there are 3 types of structures in the market. There's a trending market, there's a ranging market, and there's an outside range market. And like I said, as we analyze, we are looking to study where the market is likely to go next. We're going to walk through a couple questions, but at the end of the day, if market structure is a weakness of yours, these next 3 questions are going to be very valuable in your toolbox. Number 1, why understanding market structure is vital for successful trading. It's vital for our fund equity, and it's vital for our mental health. So first, we're going to talk about our fund equity health. As we understand where the market has just come from over the past hour, the past 4 hours, or even the daily, if we can jump on for the ride to where it is most likely to go next, we have given ourselves an edge. If you think of Las Vegas, we can use house money as an analogy. As we are gambling at the craps table, any edge that we can get over the house will help our bottom line fund balance, whether it's our fund equity account or just money on the table. How so? Well, because we're able to use this information, we're not using it to guarantee winning trades, but we're using it to help formulate a plan A, a plan B, and a plan C you later. So our plan A gives us a directional bias. As we are in our trading session, we are looking to improve our equity curve. But our plan B, that's going to help us protect our losses. As we pinpoint the area or the area in the market where, if it crosses against us, that's going to give us confirmation that our first setup is no longer valid. So that's going to be moving us into fix-it mode. As we manage our trade through such methods as win while losing, recycling our trades, picking and popping, as we work to move our break-even line up to within striking distance, and if need be, getting out because we're in obligation mode at either break-even or just above break-even, or even a little under break-even and getting that reset back to 0. That's all a part of our plan B. And that is all a part of our original analysis from the market structure. Now, if we set up our plan A and that doesn't work out, and we set up our plan B and that doesn't work out, we also, through our market structure analysis, we have our plan see you later, which is hitting the red X. Getting out of all of our trades when the market did not follow plan A, when we tried to manage our trades through plan B, and after all of that, when the market's being dumb, what do? We put the market in timeout, we hit our plan see you later, and that's hitting the red X. All of that falls under the umbrella of fund equity health. So to put it another way, plan A adds to our equity curve with minimal risk. Plan B is us managing our losing trades while still adding to our equity curve and while working in and out of heavy risk exposure situations, with the goal of protecting our starting balance with little or no net losses on the session. Any profit in plan B is just icing on the cake. And then, like we've said, plan see you later. This is our last ditch effort to contain our losses to be non-catastrophic. It can't be an account killer. That trade session's loss might cost us a day or two of profit. It might even cost us a week of profit, but it cannot be a risk out. It can't be an account destroying, challenge failing loss. All of that is wrapped up into the analysis market structure. So by analyzing and understanding market structures, before we even place a trade, we give ourselves the best pathway to protecting our accounts with a plan A, plan B, and a plan see you later. So that's point one. Point two of why understanding market structure is vital. This is for our mental health while trading. How many times in our trading careers have we done any of the following? Chase the market. We chase the market and we get burned because we entered in the wrong direction and entered in the wrong location. Or we held on to profits way too long, not even seeing the structure of the market, not understanding where it was turning, and we got burned on a 180-degree bounce and reversal and what turned out to be a major support or resistance zone. But you and me were oblivious. How many times have you entered at the worst possible location only to have that trade go against us and become a disaster of a trading session? But then after it's done, we look back and realize that we never should have entered that spot in the first place. If we would have done market structure analysis beforehand, we could have avoided that easy roadblock. Or the ever so common, oh no, I'm in profit, I'm winning. Oh wait, no, I'm losing. I got to get out. Oh wait, no, I'm in profit. No, I'm losing. No, I should stay in. No, I should get out. Arg. That's our frustration. Contrast that to this scenario. Here's my plan A. I'm going to enter at this spot. I'm going to wait for the market to come back to this spot. I'm going to fade or build my position here. I'm going to anticipate price to go here next. And if that doesn't work out, here on the chart is my plan B. Here on my chart is where I've identified the key price indicator, the KPI, where price should go. And then also, if that fails, then here is where I'm setting up my plan see you later. Does that make sense? So even before we place our first trade, we have to accept the fact that we're not in control of the market. It can do whatever it wants at any given time, but I can still close out in profit regardless of which direction the market goes. And I accept the fact that, hey, you know what? I might hit my max loss today, and the only thing I can do is my best market analysis and follow my best plan A, my best plan B, and my best plan see you later. So that, my friends, is why understanding market structure is vital to our trading success. So number two, how now? So we understand, yes, this is important. We just can't blindly open up our charts and stay on the 1 minute chart and be tunnel vision and start trading. So we understand that. But now number two, how do we analyze and then use market structure with our trading? Okay, so first we're going to go to a higher time frame chart. It could be the 1 hour, it could be the 4 hour, it could be the daily. Second, we're going to go through the next steps to determine if it's a trending market, if it's a ranging market, or if it's an outside range market. So let's talk about trending markets. First of all, they should be easy to identify if we can look for higher highs, higher lows, or lower highs and lower lows, right? A lot of times we should be able to put trend lines and create a channel on our chart. We're connecting higher highs, 2 points, 3 points equals a channel, right? Now, also one thing that is not talked about a lot is the angle of that channel. Is that angle sustainable? If there's a news event that brings that trend line vertically up or vertically down in a unsustainable angle, that is a lot different than a trend line that has been set up and that is working itself all the way down or all the way up the chart. A lot of times we'll find a consistent trend line at about a 45-degree angle. All right, now, along with that channel, trend line, higher highs, lower lows, we can also, in that trend line, identify where a key price indicator is, where the KPI is. Is it going to be breaking out of the channel? And if it does, we can mark that up on our chart. We can look for that KPI, and we can become buyers or sellers after that or leading up to that KPI. Our second market, ranging. So a couple questions we need to ask ourselves. Has the market just broken out of a trend? How many times do we see a trend going down? It breaks out of the trend and now it's going into a range. Or has the market just come out of an expansion and it's starting to consolidate? Or if you open up your charts, is the market currently in consolidation? All of those, all of that information can be found on that higher time frame, which will help you identify your KPIs, help you identify your plan A, plan B, and help you as we set up our entries on the 1 and 5 minute charts. All right, range and mark. What are some steps? Well, look to add a box around the range. Look for consolidation patterns and play our range market rules. You've seen in our hot sessions all the time where we set up a range rules. We're talking about the 1, 2, 3s of touches. The first time, does it break? We don't trust it. The second time, we wait for confirmation. And the third time, it might pop, right? Now, another part of our range rules, never place a trade at the end of a price cycle in the same direction. You're never going to know when that range is over. We look to recycle. All of this information is how we can trade during our session if we have identified that the market is in a ranging market. Where is price at in that range? Is it at the top of the box? Is it at the bottom? Is it at 50%? Are we next to a potential outside range? That comes into play to help us understand, do we need to be trading light in this area? All of this information is vital to help us with our trading. Even this simple understanding of, is price at 50% in this range? Do I need to sit on my hands and wait for the 50-50 coin flip? We've called it the 50-50 at the 50%. Now, as we head into an outside range market, our third type of market, we need to ask ourselves, are we breaking out of a range? So is there any information to the left? If we're sitting in an outside range market, we need to be prepared to use our ride the wave strategy. Another thing to be cognizant of, we need to make sure if there's any news events happening, are there any economic indicators, any sort of catalyst that can help push this market to go from one range to another range, whether it's 30 pips away, 50 pips away, 70 pips away. How many times have we been in a market where a news event happens and it pushes the price lower to the next range? All through these markets, we have specific rules. One of the rules for outside range market is to use tight stop losses and to be prepared to switch directions. So lastly, number 3, our third question of the night, how to improve at recognizing market structure. Seat time, not just any seat time, not just your butt in your seat looking at your charts. No, what we advise is seat time alongside other traders, right? You have to be around other traders who are striving to understand market structure just like you are. The more times you hear it, the more times you see it, the faster you will cut down on your learning curve. Getting into the charts. There's this little thing called back testing and live charts. So in our industry, it's been said that you can identify one specific area that you want to study, but you need to do 300 reps, meaning go back and find 300 trending markets. Go back and find examples of 300 ranging markets. If you're looking at trending markets, stay focused on them. Mark the channel on them. Note things like, this is a potential KPI. And after it broke out of that trending market, did it trend and go sideways? How many times did it come back into the trend? How many times did it continue versus how many times did it reverse? Doing your 300s is vital for your brain muscle memory. 300 trends, 300 ranges, 300 outside ranges. Marking up a live chart, like I said, we're gonna head into some charts next, but on a scale of 1 to 10, this may be a rhetorical question. How important would you say recognizing market structure is to us and our style of trading? So at this time, I do want to open the microphones up for some comments. If there's parts of market structure that have worked for you or that you want to share with the group, now is your time. Also, I want to open up for questions. And then I do want to give some examples in a live chart of how to go practice back testing. And then to close the night up, we will set up a market structure of current market. So, any comments?
Okay, I'll go first. So, as I have discussed with other people, my plan C is like my Achilles heel. And what I hear you saying, and I think that this will revolutionize my trading, is that before you get into a trade, you identify your plan C. So do you like every time you take a trade, do you identify your plan C before you place an order?
Good question. The answer to that is a no. And here's why. On the chart, I'm not identifying a plan C. My plan C is my daily risk tolerance. So before I start the trading session, I have a red X in mind. Now, for some people, it might be 2%. For some people, it might be 4%. A lot of us that are in prop firm challenges, there's a daily 5% challenge failure. So that is a hard red X moment. Another benchmark for us is when we try to do our plan B and we try to win while lose twice. After that, then it's a red X, regardless of if I'm down 1.5% or 3.5%, or I'm 6 lots deep and I really think that it's going to turn here. At that point in the trading session, things have gone sideways and it's time to go. So 2 things. Number 1, is there a percentage that you need to hit the red X on? If you have a prop firm challenge, I would definitely recommend 4.5% as a last ditch red X, because there's slippage. Different challenge firms have a different rates, and so if my parent chart is 4.5%, I may have another chart that's 4.75. So there's no reason to really gamble at that. So there's 2 things that I would do. Number 1, it's the percentage risk, and number 2 is win while losing and failing twice at it.
So can you explain what you mean by win while losing and failing twice?
Absolutely. Have you ever been with us when we've been in a plan B and we've tried to go through a couple of scenarios to win while lose?
Sure, yeah.
Okay, so in a scenario where price has gone against us over 3 price cycles, or price has gone against us over 2 price cycles, and now within the 3rd price cycle, we're in plan B. In plan B, we have the tools at our disposal of going heavy after a confirmation of the turn. And let's just say, for example, you are in a total of 1 lot throughout all of your trades in plan A and coming into plan B. You will wait for the upcoming support or resistance zone. You may wait for a 3-bar reversal on the 5-minute, and then you may put an entire lot in that zone. And the goal is to then bring your break-even line down to a within target range, right? So if price consolidates there, doesn't go anywhere, and drops again, it's headed for another price cycle down. So you have 2 options: hold on to that large cluster of trades that you just put on. So now you're 2 lots deep, and now it's going further away. Or as we've heard before in our trading sessions, if it doesn't work out, get out. So you could immediately take that second set of trades off. So that second lot, take that off, take the loss on that, wait for another consolidation further down, and do it all again. And maybe this time you have to put 2 lots on. And if it's easier for you, if you're trading 0.05s per trade, maybe at win while lose number 2, maybe you change your quantity to 0.25. Now you can only you have to hit the button 8 times instead of 20 times in that location. You know what I mean there?
Mm-hmm.
Okay, so that would be 2 scenarios for win while losing. And if that doesn't work out again, if price doesn't come back up 1 price cycle, then like some people in the chat have said, hey, if that thing went 5, 6, 7 price cycles against us without giving us a price cycle back, that's a 50 pip move, that's a 60 pip move. That's the market being dumb. That's us win while losing twice, and it didn't work out. That's see you later.
Okay, yeah, thank you. That's really helpful.
Okay, any other follow-up questions to that?
I'm good. I don't know if anybody else has follow-ups.
Yeah, anything to add for a a plan C later? Okay, Diane, thanks for the question.
Yeah, thanks for the answer.
I was just going to mention, like, for prop challenges, like, they're not all 5%, like, depending on which one you choose. I signed up for one last week, and they were giving away like, it was a 2-step challenge that I signed up for, and then they were giving away a free 1-step challenge to go with that purchase. And so that second account has a 3% daily stop. So, you know, if you're going to be copy trading, you have to, like, be mindful of, you know, where you're like, what that red X is for you, right? Like, it's not always going to be, you know, 5%. And then if you're copy
Yeah.
trading, you would need to, you know, like, sort of take into account all the different types of accounts you're trading and use
Absolutely.
I guess the most strict one as your guideline, right? So
Yeah,
anyway,
and I know of some, that's a great point, Larry. And I know some I know some traders in our community where they do one of two things. They either adjust the copy trade algorithm to adjust for that either increased or decreased risk, or they cluster all of the like-minded risks together. So for those of us that maybe have 4 accounts that we're copying into, maybe eventually there's others that have 8 accounts or 12 accounts. They'll have 3 sets of 4. So maybe this group on the left have one set of parameters, this group in the middle has another, and then, you know, they're just going to group together like-minded. So there's a couple ways to do that, but definitely read the fine print. I saw in the chat that some people do add a plan C at the beginning. Josh, is this something that you'd be able to highlight for us?
Yeah, sure. And it is based on market structure, so it's relative to the conversation. Like if you're buying in an uptrend, for example, then your plan A is to buy, especially on the pullbacks, right? Do you have your KPI in the structure that you identified at the beginning, like you were talking about, where you would go into a plan B? And you're like, okay, well, I need to get on my buys and I need to switch to sales here. Well, there's another point below that I'll usually classify as my plan C at the start, because if news or something yeets it down there, it's going to be irrecoverable if I'm set up for profit in my plan A area and don't even get a chance for my plan B area. So it's like a plan C from a high level, from a bird's eye view. And as I go through trading, my plan C usually gets modified based on how deep I'm in a trade or how close I'm to the KPI, or if Pal's about to speak or something like that. I will adjust my plan C. But to start, I always do have one.
Now, would you say that your plan C is a stop loss, a magneto stop loss?
No, it's an area.
Still...
Yeah, no, it's an area in structure where my play is not going to work. So don't.
Gotcha. Okay. All right. I pulled up a chart here. And as I'm setting up to look...
that, I have a question about this whole plan ABC thing. So how, I can't get my camera on, not that you need to see me. So how much time, percentage of trading, Josh and Pete, do you think a typical trading session would end up in plan C? Is it a really rare event, or is it something we normally would experience once a week or something like that?
Good question.
You want me to answer first, and then you?
Is it a daily event, Josh?
No. As you get better, your plan Cs will get further and further away from you, because you'll have more tools in your tool belt, like win while losing, pick and pop, all this other kind of stuff, right? And you'll realize that you don't need to gamble everything on a single trade. You don't need to make your goal on the next move. And David talks about seeing a goal move, but you're not trading as if every single time you hit the button, you're going to do a goal move. You're going to evolve past that type of trading, and you're going to get to to where it's just this bicycle ride type thing. And as far as a plan C, I always plan for it because you have no idea what the market can absolutely humble you in
Anything.
2.5 seconds. So you always have it and you always adjust it and you always move it, especially if you change your plan A or you change your plan B. You always have it with you so that if that occurs, you're not frozen. You can make the decision you decided ahead of time.
You know, I think that's really key, what you just said about being frozen, because I think that when we're new to trading, that's what happens. We don't know what to do, so we freeze. And that's what destroys accounts.
It can still happen to seasoned traders. If you've got a nice plan A and you're in your groove and you're just making all this money and it's just like you're just dumping it into the account and all of a sudden, I don't know, a war breaks out and price eats 550 pips. You can freeze even at that point. Like what happened? What happened? You know, well, having a plan laid out for yourself, at least in the back of your head, helps you not freeze or helps you make that decision.
Mm-hmm. So what I'm thinking about is when the market structure does an abrupt, unforeseen change. Not that when it's all of a sudden has a spike in the same direction, it's like, whoa, where did that go?
Sure. And I would say,
right?
I would say when, if your original question was how often is that plan?
Yeah, how often do you think it happens?
Like Josh mentioned, the longer you spend time in the seat, and most of us are going to tell you it's going to take a solid year of daily trading. You're going to run into events where you're going to say, I didn't even see that news event, or I thought it was a normal news event, but that was a talking head. And in that talking head, when I started to fade the candle, it never came back. So guess what? Now I'm never going to trade during a talking head news event. So there's experience that you have to learn by yourself.
Mm-hmm.
Here is a canary in the coal mine sort of benchmark. If you find yourself risking out once a week, if you find yourself in the red zone of over 4% and your plan C later is 4.5 or 4%, you're 4.5% and you're right on the edge of failing the challenge for the day. You've got to turn around and analyze what it is that happened in that trading session. Were you too heavy? Did you not see something in the market? For example, a great example early this week when we set up trading overnight trade setups, and there was a group of us that looked at the chart and said we're setting up for buys, and there was another group that set up for sells. And in the morning we talked it over and said, what was happening in that market structure? What did you see versus what I saw? Now that we have that experience, now we can learn from it. So the things that are in your control is your position size, when you get in, when you get out, right? We don't know if it's going to be a 5 price cycle move or if it's going to be a 1 price cycle move. But what we can control is, number one, our plan A and our plan B. And on a side comment, the reason that I don't put a hard plan see you later on my chart is because I would say of a couple things. And as Josh was talking, I want to show this as an example. If this is right here, what we just opened our chart up to, and maybe even, I don't know, that or something. So we're able to see, this is a 1 hour chart, that we can connect the tops, that this is a nice channel, give or take where we're putting the bottoms. And there's even a nice midline, right? So from here, if we're sitting here, we can look at this, and as much as I want, we can identify if it breaks out of this channel and consolidates, where is this channel done? So this could be a KPI that we are no longer selling. Now, The reason that if I were to zoom in here, and there we go. I don't think I zoomed in. There we go. So if we were to zoom in here, and we are playing this position, if I stumble into a too heavy of a position, I may have set a mental, and I'm just throwing this out here, I'm not overanalyzing. I may have set a mental plan, see you later right here, right? Maybe 4% is up here and I deserve to X out because I was wrong. But because of the way I played the market, either I got in too heavy or either I didn't get out on a reversal like I should have. Again, this is a 1 hour, but still the candles are the same principle. I may be too heavy right here to wait for my plan C. So and I'm not saying that Josh's method is wrong or my method is better or worse, but this would be a rationale for if my plan C later comes earlier or later based off of your position size, that's all a part of your pre-trade setup. So if Josh is very comfortable with setting a plan see you later, but we have a different trader here who doesn't need that see you later, because they will understand once they win while lose in plan B, they do that twice. And now price is here and they're at 3%, and they know that the next target is there, and they say, I've ran out of bullets and I fought this fish for 4.5 hours. I made a bunch of errors and my market analysis was did not work out the way that I set it up to be. And I'm hitting my red X right here. Does that make sense?
Yeah. Hey, Pete, if I could add to that, because that's really good.
Go ahead.
One of the things I do see us quite often get in trouble, especially in our earlier years, is we will have a plan C, but we usually max our positions or our bullets or whatever out well before we get to it. And so we end up with these really deep drawdowns. If you asked me again, when was the last time I planned seed? Actually, I planned seed my hot seat day. And I hadn't planned seed in months before that. But for whatever reason, I couldn't read that market to make money. Every time I went into buys, it went down. Every time I went into sales, it went up. And I was win while losing. I was picking popping. I was doing everything as damage control for whatever reason. And that was just me that day. I planned C at negative 0.4. Not because of structure, not because of how deep I was or how heavy. I got negative 1.2 at one point, which is not terribly bad on a normal trading day. However, for whatever reason, I was not operating normally. So I adjusted my plan C off of structure to, okay, get to something you can make in 2 days and plan C this, because you are not making money today.
Great information. Good questions too.
Sounds good.
So if I were to show just a couple of examples of how you could back test, this would be one example. Take a moment to zoom in to cut this out and just pay attention to first of all, what angle was this, right? This angle is a lot different than this angle. This is an unsustainable move. This is a move that has been set up over time, right? The big bankers, this took a lot of money to get this move to set up. Now, when that move is done and it starts to consolidate, now, do we know where it was going to end? No, but can we set up in our market analysis some KPIs for ourselves? If it breaks out of the channel, it's going to be somewhere over here. We're going to connect a dot. I didn't pull up my Zoom tool. Oh, wait, here we go. All right. So when this channel was happening, we can look and kind of future cast out. Well, if the market turns somewhere over here, it's going to consolidate, and it's going to continue down, right? So this is a KPI continuing down. It's testing. It's created the range. So now if this is Monday, that's that's a one market. If this is Tuesday, this is a different market structure, right? So that is how you can look at a market like this, hop in a chart, and see how it expands, consolidates, and either chooses to go up or chooses to go down. This is an hour chart. So this could have been our entire trading session on one of these days back on June 1st, right? So this is the type of back testing that you can do. So you, depending on how much you want to spreadsheet this out and make percentages, you can keep track. This is one. When it broke out of the trend, it did not continue. Okay, we're in a second trend. Okay. How do I identify a trend? Well, did it make higher lows? Can I connect more than 2 points? Right? So here's another trend. How did it react in that trend? Was it a 45-degree angle? Was it sustainable? Was this a news event? Are we in an outside range? If we're on a 1-minute chart right here, there is no information to the left, right? It's tumbleweeds. We had to come out to the hour to see support and resistance, support and resistance, support and resistance. So this guy's taking off. If we were in cells here, what information from the structure can we gain from this? So over and over again, we have to get burned to help us learn. And the emphasis, as I close out this, the emphasis on market structure that I'd like us to walk away from is this. Simply understanding that market structure exists, and simply understanding that when you open up your charts as part of your daily routine, you're working out your price cycles, you're working out your short-term bias, you're working out the market long-term bias, which is the market structure. As a group, if we can continue to work on those elements, you will become a much better trader, which will then help you with your plan A, give you confidence to work through plan B. And on those rare occasions when it just does not work, then you see you later and you save your account and you live to trade tomorrow. That's all I got. If there's any other comments or questions.
Okay, I have a question. Could we look at the 1-hour chart currently? Because I have a theory and I wanted to see if so like at today's price. Yeah.
You bet.
And can you zoom out all the way and draw the trend channel?
You bet.
Thank you.
All right. Now, Diane, would you agree or disagree with the top trend line? Would you put it somewhere else, or is this good enough for what the?
Yeah, I mean, I would draw the trend line all the way to current price.
Okay, so you would bend it this way?
No, I mean, just like extend it. There you go. Keep going.
Okay, all right.
Well,
Gotcha.
I guess I would draw the top trend line a little bit differently. So I'd,
Okay. Do you have Zoom controls? You want to grab the pen?
Let's see. Where do I find the
Duke,
pen?
you stole her thunder, Duke.
There you go.
Yeah, it should be an annotate.
So, well, so basically on the downtrend, the way that I drew it, the way that I drew it, I see right now at this very minute, it's coming to, and you can see it on this uptrend chart, it's coming to a bounce point where it should be a good buying opportunity. So the way I drew the downtrend, I see it coming back to test the breakout of the downtrend. So
are you writing on the chart or not?
No, let me what do I click on to annotate? Where do I find my pen?
On the normally in the bottom left, there's a little kind of pencil icon.
Oh, I
So
see.
if you hover over that, it'll bring up your tool chart.
Okay. Let's see. So so I've got my tool chart. Where do I choose the pen, or does the pen automatically? All right, I got my tool chart.
Yeah, there's a text, there's a draw, there's a check mark.
I've got underline. Yeah, sorry, I'm like,
That's fine.
behind the times on this.
You'll learn the first time and then you'll know it, right?
Right.
Yeah.
I've got
Would you start it
oh,
up
I
here at
see
the
it.
top?
Okay, got it. I think.
Okay, awesome.
No, I don't have it. Anyway, so basically what I wish I could.
Are you
draw.
starting? Do you want me to start here?
Yeah, so start up here at the top and draw it. I keep doing it with my cursor. Let me see if this writes for me. All right, hang on.
I suppose I could, if you have a chart up.
Oh, I know what the problem is. My chat is covering it up. So let me close the chat. Let's see. Oh, here's my pen. Got it.
Woohoo!
Okay. All right, so the way that I drew it, I think this is going to draw for me. Yep. So I'm coming basically, I know this is like, so basically here. Well, that got a little zigzaggy. So,
Okay.
so drawing it, from here to here and hitting this top point, hitting this top point, what I see is that right now we're down where there you go. We're retesting the breakout of the downtrend. So, which I had identified a couple of days ago that was a possibility, that we could come down and retest this channel line. So is that a correct market analysis?
So there's a couple of, I'd say maybe schools of thought on channels, right? Some people may think that this is not a valid trend channel, even though it's a trend. This may be one. But to your point, regardless of if it broke out of the channel and is coming to test back, or from the original channel that we were talking earlier, either way, it broke out of the channel and it's coming to test back, right?
Yes.
So now where you're sitting right now is, there's nothing wrong with that being identified as a KPI. One thing that is very, very helpful is to go back into the past after you drew your trend line and see just how often that was respected. So there's my trend line that price is almost bumping on. So you see how price hit it, went away, went under it, came back over. And from January to February, it never came back. Then it hit again, then it hit again, then it hit again. So this looks to be a very influential bounce point or break and continue point. Now, what does that tell us?
You.
I mean,
Pete, that is so helpful to look back into the past like that. I never ever would have thought about that. So thank you.
Oh, my pleasure.
One thing I do is I leave my fib charts on sometimes, especially on the higher time frame charts. It's fascinating how many times fib charts repeat themselves precisely at the same line.
Oh,
sometimes
interesting.
6 months later. Yeah.
Yeah. When to comment off of what Josh wrote a little bit, with the difference between the trend line that I made and the trend line that Diane made, although they're very close, the only rule of thumb is like what Josh typed in there. You really want to hit a trend line with as many touches as possible.
Yeah.
So, but again, regardless, you can I made a point to say this earlier in with the correct wording, that we're trying to put ourselves in a position to have the best probability of an outcome. We can do the best market analysis. Exactly what Diane did here, everything that she's seen is brilliant. But do any of us know what price is going to do between now and here?
It's going to the right.
It's going to the right. So at the end of the day, the only thing we can control is, do we get in? Do we get out? Do we sit on our hands? Do we react to what the market is going to give us? And let's say, for example, Diane, you say, you know what, I'm gonna play the bounce here. We're at the end of a price cycle, and there's 8 different pieces of evidence that you found when we go down to the 1 minute chart. And even if let's do that, so I don't have to talk in hypotheticals. So we go down to the 1 minute chart, and we want to set up a night setup. Okay, so we know that, oh, I didn't know the chart did this. Oh, that's cool. All right, so we know that it touched. So based off of your experience, Diane, when a market touches and touches and touches and touches, and it's starting to create this type of a pattern, there's many traders that look at this as maybe a falling wedge, maybe it's knocking on the door, it's creating lower highs, it's giving the evidence that it wants to, some would say break, some would say it's going to fail, and then we're back up this way, right? But whichever way Diane chooses to play this, if she sets up for buys, well, she's got to look over here, because this is wide open, which means that this could be setting up for an outside range. We've got to look to the 1 hour for our support and resistance. If buys are wrong, well, then she's got to work. And when I say wrong, I mean her plan A didn't work out. She's got to work herself out of that. If Diane thinks that this is going to be a sell market, and for all the pieces of evidence that she can talk about, then she's going to build into sells, or build into sells and manage her trade as it bounces up. But either way, Miss Diane, if you create yourself a plan A, a plan B, and a plan, see you later, you should be fine.
So could you go back to the 1 hour chart for a minute? Because I have a question about the plan see you later.
Okay.
Thanks.
All right.
All right. So we've got here. Now that I found my little annotation, so we've got right here, if I can draw, the support line, that it's, in my drawing, it's come back to the trend. So it should bounce there. So it seems like if it doesn't, there's a KPI here that it shouldn't go below that. And then there's another KPI here that it should hold that. So if I were, if I wanted to get into buys, where would and maybe this is a question for you, Josh, since you plan out your plan C in advance, but if I didn't want to say, okay, I'm just going to have my plan C as my daily max loss, is there one of these points that you would say, okay, if it breaks below this, then it's broken and I'm just gonna X out?
It depends on how you structure your strategy and your plan. KPI, how you look at a market, kind of how Pete went over pretty good, is arbitrary to the trader. What you see is what gives you your edge, because it's what you are able to trade to make money.
Okay.
My point in the chat was to have your channel to touch as many points as possible has a tendency to increase the accuracy of whatever plan you decide to make. So for example, and if I can doodle on the chart a little bit,
Yeah, let me,
If-
here, I'll do that.
yeah, go back to the hour since that's one we've been using.
You bet. So this is the hour. I'm just going to expand out. Is this okay, or should I go one? Let's just stay
Uh,
there. Here we go.
No, can you go out? Go out because that's what we were discussing.
Okay. What a big.
Like for that one, you can absolutely make a play off of that. You're going to touch this guy, you're going to touch this guy, you're going to touch this guy, right? And according to your logic right now, you've got a bounce point or a high probability bounce point, right? You can absolutely make money and strategize this play. What I'm by not putting it on the most points and putting it on these outliers, what I'm saying is you're reducing the accuracy and costing a few high probability trades to yourself. So yeah, Pete, can you bring it in to like these guys and these guys to make it a bit more
Yeah.
Oh, yeah,
Yeah,
I
so,
see.
no, bring it
Now-
in some more, have it touch. Yeah, okay. So look at
Sure.
this, Diane. Now these guys aren't the touch points, they're the outliers. So you
Oh,
have
yeah.
high probability to make money on sells on these guys back into the trend, which is huge bias. Whereas by looking at it further out on less touch points, you cost yourself that ability to see.
Okay.
Now, whether or not they're actual turn points, because these are KPIs they're at. You see these KPIs for a turning point,
Mm-hmm.
you are at risk
And-
for a
and-
turn here. But if it goes your way, you have a low risk and a lot of money to make on the way down.
And I don't know if I if I shared this thought on the KPI, but Josh has thrown this out. One other way to think about the KPI is if the market breaks in this KPI level, that means that the current move is likely over. Okay, so in this scenario, when this outlier broke out here and we had this that it had to bust through, if it continued,
Major KPI.
that tells everybody not so much where we can trade in the next minute, but it tells everybody that's paying attention that this move is over. Now we're entering a new move. So the reason that I felt, again, this is subjective. The reason I felt that this trend line with all these touches here and X'd out of these outliers, what this was showing, potentially showing us is this move is over, and Duke earlier on drew this as a likely start of a new move, a new position, a new trend. So when we go from, it goes from trending to ranging, it goes from expanding to consolidation, and that happens all through here. Boom, 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 boom. We got this, 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 this. Now we're back into a new move. Now, could this drop back into the channel 103 pips? Absolutely, because we're not in control of this. And even if we draw the prettiest market structure, it can do whatever it wants. But we have to play the probabilities. And the probabilities could be that this move is over because it's not at the top, it's at the bottom. So if anyone's ever heard of the concept of Elliott wave theory, there's 5 waves, 1, 2, 3, 4, 5, or something like that. After the Elliott wave, after a move is done, it normally comes into a consolidation for a little A, B, C, and then starts the next move. Is that next move going to be up or is it going to be down? We don't know. So your market analysis, Diane, of starting to put sells in here, what's very wise of Josh showing you is just by adjusting the trend line, there's a longer gap of 70 instead of just maybe 28 or 30.
Mm-hmm. Yeah.
Well,
yeah. Go ahead.
There's another piece to the change that's occurring just now, because this happened here, it happened here, it happened here, and it happened here. And we can't say with confidence that that downtrend continued until, today. Back then we would be guessing, or we'd be playing a high probability sell type thing. What makes what's happening now different by drawing this trend line so much closer to those multiple points is if it continues through like this, we can with a lot higher probability say this downtrend is over because of the time. We got to remember time cycles. This is how much time it stayed. That's how much time it stayed. That's how much time. That's how much time. Again, that's how much time. It's way past its time cycle. Way. So now you're in consolidation. We always go from expansion to consolidation. So you're in at these KPIs, this consolidation. What you can see is you can start to draw another trend, even though it's not really confirmed until it breaks these major KPIs. It tried, it failed. It's got to break this KPI too for us to say we're going this way, right? But one thing to note, and I'll clear my drawings a little bit, how you saw this out here, and this is why what you saw is not wrong. There's no way to do this wrong. You see, even by doing that, we're at the exact same decision point you had seeing it your way as we do seeing it our way.
Mm-hmm.
You see that?
Yeah.
And
so it's not that anybody's ever wrong, because that's what makes each of us good. That's our edge as a trader, as a human, as a person. That's why Diane gets accounts to trade. So because when Josh loses, Diane sees it correctly, and Diane's making money, right? That's that diversification of traders.
So Josh, if you had to pick a direction right now, would you be in buys or sells?
I actually just got out because it was like at a indecision point, and it's at night. And I didn't have an answer to that. But on the hour, let me.
Sorry, I have to mute my television.
See can you zoom in a little bit, Pete?
Yep.
So on the hour, and you were talking about the KPI a minute ago, this is we just crossed a major KPI, and I played sales for that down to where it's at.
Mm-hmm.
Because basically this whole up play right here was over, which it kind of expanded to that, right? But once it broke this KPI, the ups are no good anymore. And oh yeah, like Lee's pointing out, you have a head and shoulder. Everything's pointing down. That looks really bad. I'm gonna erase that. That looks really bad. And so I played the sales off of this game because of the KPI potential break and head and shoulder formation. However, where it's at now, it's really, 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 really close to this. So I would start technically getting into buys for the bounce of this. But it's night, it's 10:30. We usually end up with these Tokyo drifts. I'm not going to do it at night. In the morning, I would probably buy, because this is our next KPI, right? It's not a plan C KPI like you were asking, for me anyway, because you can set up plan A here. You can set up plan B through here. And it's not even a plan C if it breaks that guy, because you got this that it could bounce off of. I mean, if we were playing the 1 minute, on the 1 hour, this is probably like 40, 50 pips. So it's a very different conversation. But you can play through all three of those zones, and the odds of you getting retracements to make money is really, really high. There's not a lot of risk at the place that it's at, because if you look at your KPI, which is this guy right here, off of this downtrend, we're now in a consolidation. You're at the 50. So be light, because you don't know where it's going to go. The market doesn't know. It's got to make a decision. That's kind of why I'm out. It's at the 50 at night. It's just too much uncertainty for me to stay up to 2 o'clock in the morning.
Yeah.
But
I get that. Yes,
okay.
thank you.
Yeah, well, and also as part of our trading method here, this 3 and 50, right? We're looking at 50% of price cycles. We're looking at 1, 2, 3 touches. All of the things that you've seen and you've done yourself as part of our trading method. Not once has a market ever gone from here. I don't say not once.
Yeah. Don't jinx it.
How often does one candle go like this? and then
Not
go like
very.
this. I don't see any, I mean, this may be a news event. This may be a news event, right? But for you to have the confidence of, I'm going to set up buys. I'm going to set up my first layer, my second layer. By the time this comes, I'm going to have X total position. And by the time it comes here, because it goes like this and up 2 and down 1 and all of a sudden it goes up 3 and then it goes down and down and down. So we know that we probability wise will have the ability to work out of our trades if our plan A doesn't work out 100% like we want. The danger that I found myself numerous times was being overconfident in the fact that on the 1 hour, oh, it broke out of the trend line. We're going up. I'm going to buy and I'm not going to even look to the left or look to the right. This thing is a buy, baby, buy, right? But count these pips. 29 pips. Even this move here that Josh pointed out, 27, 64 pip leg. The way that we trade, not many of us survive 64, 65 pip legs. And then in the morning you wake up and you find that the market eventually went to go be a buy anyway. So a common thread is I was right in my bias, but wrong in the timing or how it got there. Whatever Dave
Right
had said
in
before.
right in the direction, wrong in how it gets there. But that
Yes.
goes back to literally what we're talking about with Diane. Dave, whatever your name is, Pete. Oh, this is why I'm not trading. It's late. Pete drew out what he sees, right? Well, Diane or somebody else in the market with more money or more people sees this trend line. And that's okay because the KPIs are down here, right? So they're not buying until down there, which causes the market to kind of go past what Pete drew right here. So you don't want to over leverage yourself. You want your position size to be done correctly. You want to be liked, especially when you start, because somebody else is looking at the market differently than you and making their decisions at those points. Like Diane was making her decision off this line, and several of us were making our decisions off this line. We merged at that point just because structure works that way. But you see how two different decisions can cause two different plans. And the thing about the market and what makes it work, two people have to have diametrically opposing views of where it's going for their own reasons. Market structure, what they see, the whatever. They're diametrically opposed. Somebody's buying, somebody's selling.
Yeah, this is incredibly helpful. And honestly, I would have been in buys an hour ago, but the volume, when I haven't checked it recently, but the volume then was so non-existent. I thought, well, I don't want to get into trades when there's no volume. And then, there's several major news events tomorrow morning and starting at 8:15, not starting at 8:30. So I have no idea how the news is going to impact what the trend is going to do.
Tomorrow's going to be
Right,
epic.
so-
It's unemployment and that sort of thing.
So we're a little over an hour, I suppose. Here's one last comment, and then we'll close the room out. One of the best things about Trade the Fund with the way Dave has set us up to trade is we are not his robots. He's not texting us or emailing us call outs or signals in the market.
Right.
So what he is doing is he is teaching us how to fish. He's not giving us a fish. What that means to me is
There you go.
going back earlier, if I identified this and Diane identified this, and at the end of our trading sessions, the two of us came out green, that was brilliant.
Yeah.
That's brilliant. That is the goal, is to come out green, because Diane was confident in her analysis and Pete was confident and everyone else in this room was confident because they've learned what market structure is, how to analyze it for themselves, how to identify it, and then how to implement their strategy to earn this.
That's a very good point.
Yeah.
And as long as we follow the basic rules, you can make money whether it goes up or down, and whether your plan A was where it went or not. And so yeah, focus way less on I was wrong or I was right, and more here's my plan A. Did it play out? No. Okay, well here's how I'm going to make money in plan B. Using the same
Yeah.
basic rule set.
Mm-hmm.
Because it's not
So-
about being right or wrong. It's about making profit.
It's about the Benjamin Pips.
It's about money.
There you go.
Hey, I really appreciate you guys sticking with us. We started a half hour late. I hope that didn't cramp anyone's style. I am looking forward to seeing you guys in the morning. And again, thanks for hopping on with us.
Yeah, thank you. This was awesome.